Hey everybody, Jason here. Happy Tuesday. Hope you guys are all having a great day. So today we had the bounce back up on Tesla. Hopefully you guys got some put credit spreads or something while it was way down, because that was pretty much easy money. You can see we grabbed we got this on percentage. Let's see, total return. So you can see we grabbed this one a couple days ago while it was down, up 34% on that. And then when it went down a little farther, where's our other one we grabbed? Oh, it's right under my cursor. This guy here, and I think I did this one live while we were just kind of looking through things and going, man, 55 bucks yesterday. If I can grab that on a 600, I think it's pretty much free money. So we grabbed that one, not expiring out, very far. So pretty near term. And, I didn't know that the bounce was going to happen this soon, this quick. We know we do have a catalyst tomorrow, which is AI Day. Don't know that that's going to mean a whole lot for Tesla's value, but it is something people are looking forward to. So as I said, my thoughts were, okay, we had the bad report. People misinterpreted that as something that lowered the value of Tesla. The next day after the report, people who don't trade with a phone in their hand and look at it 50 times a day, they may have taken positions off. And that's why we saw the second day of dip. And then the rest of us who believe in Tesla looked at it and said, what a great opportunity to buy. So that's when we were able to grab the leaps. And thinking through it a little bit more, I should have waited till the second down day to grab it, but that's fine. Grabbed it on the first, and we're still profitable on that. So that thing is looking pretty good, but it's in my TD account. Paid quite a bit for it. I'll post that one in the Discord, the one that we grabbed. And other than that, let's also take a look real quick at a couple of these little plays. So someone had said, hey, I don't have that much money, I can't play Tesla. But here's an example of one I played for $34, so pretty cheap. You can see what they are. It's a cheap butterfly here, and that's Tesla making it back to 705, and this could be $34 into theoretically $466, but Tesla does close things out an hour, or not Tesla, but Robinhood closes things out an hour before market close, so we'll never ever see the maximum gain, but we can sure, close it out when it's 100% or something like that. So that is one cheap play. And another relatively cheap one that I did was this long condor. And if we look at this, we were actually up about 60%. So I bought this for $100, and then we had the drop. Yesterday, I could have opened one of these for $20. I mean, you can see the price got down to 17 bucks. Could have opened it for 20, 25, and then been up, 400 or 500% when it bounced back up today. These are not, these are low probability, but, so high risk, but also high reward plays. And I thought we would see the bounce by the end of the week. And again, I didn't know it was going to happen quite this bit. I thought we may have seen kind of a new level where it was going to consolidate around, but happy to see that, of course. We did roll out 660s and 650s a little bit, because if it did not recover so fast, I wanted more time on that. So we do have more time. Otherwise, if we would have diamond hands those, we would have been in a stressful position if we did not recover like that. And we could have potentially lost all of that. But now we're just waiting, 2-3 more weeks to realize that full premium that we got on those plays, which is fine. Couple weeks, 2-3 weeks, even a couple months over the course of trading, just not a big deal at all, especially when we don't have to have those plays in jeopardy. And this is also just a really good reminder. So the reason it is ideal to open up put credit spreads, a month out, 4 weeks out, 6 weeks out, quite a ways, is so when we do have dips, if that dip happened on a Wednesday or a Thursday, and we had short-term expirations on our plays that were anywhere near the money that we were pretty confident that they were going to just expire worthless, or we were trying to gain more premium on, we could have just been just beaten up on those things. So even though I do have near term ones, those are not ideal. And it's kind of like when you go to the doctor and they tell you need to eat better, exercise, you're overweight, and it's coming from a big fat doctor. It's kind of the same thing. I know what the correct thing is, but I don't always do it. And that also gives me a lot more risk and volatility, but also, then we also have more gains. So looking back, over these last few months, so when we're seeing, or you guys are seeing like kind of some crazy downness, if you just look this past quarter, we've had times where in short order we were 145 all the way down to 120, so $25,000 down in the matter of a week. We've had highs 175 down to 145. That's a $30,000 difference. And then just this dip here, we were looking at we had a high of somewhere in there like almost 190 down to 150. $40,000 down. So that stuff will happen. But overall, I like the overall trend. But just one of those things to keep in mind that totally can happen. We're trading things that are very volatile. We have nice upside on them, but with nice upside also does come downside and the volatility with that. And I firmly believe the reason 90% of traders lose money is because maybe they started their account here and then they dip down and they see that 20% loss in their account and they're like, screw this is not for me, I can't handle it. And especially when you have your first real downtime, that's scary stuff. But when we've been through it a few times, it becomes more and more numb. And when we're more and more comfortable being in the red for a period of time, we don't make stupid, ridiculous decisions and like just cash out or close all the positions or anything like that. There are several ones that I had on earlier when Tesla was up at 800, 900, pretty close, and I decided to close some things down because we were steadily dropping. And if I would have kind of just stuck to my guns and rolled those things out, I rolled out quite a bit of them, but for the most part, I would have ended up positive. I would have definitely been, as far as account value, a lot higher than I was, but I was seeking a little bit of refuge and a little bit of protection from just like more downside, because it did wear on me. It's definitely emotional and very, very fatiguing to see like down day after down day. Last couple days in the past may have been a little bit worse on me, but since we've been through it a few times and I have the super high conviction on Tesla long term, didn't matter so much. So just in the back of your mind, if nothing else, keep in mind the last couple days and see what that overreaction looked like, and then where we're at today. And if we would have quit at that point, we definitely would have not been happy with the recovery we could have seen today, potentially by holding on to things. And actually, if I had not rolled over my 650s, 660s, it would have been up even more. But that's kind of that balance between that is the balance right there. Keeping some of it safe, not wanting to be completely overextended or worried, or waking up at 4 o'clock in the morning to see what things are doing overnight. So if you guys have any questions or anything, let me know below and I will do my best to get them back to you. If there's any specific plays that you want to see, please let me know. That's tends to be one of my favorite things, when somebody asks for something specific and we can talk through it, walk through it, kind of step by step it, and maybe educate someone along the way. All right, guys, love you guys. Have a great day, and let's make a lot of money.